Credit card debt in the US has exploded. We're talking trillions, and if you're not careful, the interest alone can eat your paycheck. Today, I'll explain why 2025 is different, where the pressure points are, and, most importantly, exactly how you get out before the interest devours your future. Stick with me for the next 12 minutes and you'll get A. The three big reasons card balances are surging in 2025, B. A real dollar escape plan with math you can use tonight, and C. A 30-day action checklist to cut interest costs fast and sleep better. Maybe you've seen your monthly statement and felt a pit in your stomach, balances ticking up, minimums increasing, APRs higher than a year ago. You're not alone. Millions of Americans are watching their cards go from buffer to burden, and the signals are showing up in national data. Quick snapshot. As of mid-2025, US credit card balances sit around $1.2 trillion, up significantly year over year. That's not a small uptick. It's a systemic jump that's stressing household budgets and bank balance sheets. Keep this number in mind. It's the backdrop for everything we discuss. Why should you care? Because credit card debt is not just a line item, it's a compounding tax on your life. High APRs, the average for cards that carry interest is north of 22% in 2025, mean that carrying balances becomes exponentially expensive very quickly. We'll show you the math so it stops being abstract. Section 1. The three root causes. Reason 1. Higher interest environment. The Fed's rate hikes over recent years pushed short-term rates up, and revolving credit repriced quickly. New card APRs and rates on accounts that accrue interest are far above historical norms. That makes carrying balances costlier. Reason 2. Cost of living and inflation squeeze. Wages haven't kept up with price increases everywhere, so more households are using cards to cover essentials, groceries, gas, medical bills, turning temporary liquidity gaps into persistent debt. The data shows purchase volume rising in 2025, even as consumer caution increases for lower score borrowers. Reason 3. The student loan reset and lagged effects. As federal student loan forbearance ended, many consumers faced resumed bills and higher delinquency risk. That pressure often pushes households to lean on cards. The result is a broader stress pattern: student loans, credit cards, and auto debt moving up together. What that mix produces is dangerous. More people carrying balances, higher average APRs, and an increase in delinquencies for the vulnerable population segments. Regulators and the Fed are watching this closely. Rising delinquencies are already visible in multiple regional reports. Let's be brutally practical. How much does this really cost you? Example, a $5,000 balance at 22% APR. If you only pay the minimum, assume 2% min, you'll be paying interest for years and could pay thousands in interest before the principal falls meaningfully. Later we'll run exact numbers so you can compare options. Section 2. The human consequences: higher monthly stress, lower credit scores from higher utilization, reduced borrowing power, and delayed financial goals like home ownership or retirement. People tell me they feel trapped, and the data backs that feeling up with rising average balances and utilization metrics. Before we panic, know this: there are concrete escape routes that work in 2025's environment. The path is the same as always: reduce interest, reduce balances, and increase cash flow. But the tactics and priorities change when APRs and macro pressures are high. I'll prioritize the fastest impact moves first. Move 1. Immediate. Stop paying only the minimum. Minimum payments are built to keep you chained. They cover interest first and chip away at principal slowly. Even a small bump, $25, $50 extra per month, shortens payoff and saves real dollars. Let me show you quick math in a minute. Move 2. Attack the highest APR first, avalanche, or use a psychological approach, snowball. Pick the one you'll stick with. In 2025, avalanche usually saves more interest because APRs are so divergent. Pick the card with the highest rate and accelerate payments there while making minimums on the rest. Move 3. Balance transfer to a 0% intro offer. But be smart. Many issuers still offer 0% for 12 to 21 months with a transfer fee, 3 to 5%. In a high APR world, transferring high-rate balances into a 0% window is one of the fastest ways to cut interest, as long as you pay down aggressively during the promo. Move 4. Consolidate with a personal loan, fixed rate, fixed term. If you can get a personal loan at 9-12% to pay off 20-30% APR card balances, the savings are immediate and the payoff timeline is predictable. This is especially useful if you don't have access to balance transfer offers. Move 5. Negotiate and shop. Call your current card issuer and ask for a rate reduction. Many issuers will lower APRs for customers with good payment history and competing offers. Also shop for new offers. Shopping around can reveal 0% promos or lower rate consolidation loans. Never assume the first offer is best. Now the math. Live example. $5,000 at 22% APR, minimum 2% monthly. If you pay only minimums, you could be paying for many years with total interest easily exceeding the principal. But if you switch to a 200-month payment, you'll be debt-free in 34 months and pay far less interest. The exact savings depend on APR and payment size, but the pattern is universal. Larger payments collapse interest fast. Let's walk through a balance transfer scenario. Same $5,000 at 22%. You transfer $4,500 to a 0% card with 3% fee. Cost of $135. If you pay $375 month, you clear the transfer in 12 months and only paid the fee instead of thousands in interest. That's the power of temporary 0% offers. Use them as a turbocharger, not a permanent crutch. Behavioral rule: never treat the new 0% line as free money. It's a deadline. Set automatic payments that clear the transferred amount before the promo ends and block the card for discretionary spend if you must. Discipline is the difference between success and disaster on balance transfers. Tactical checklist you can run tonight: 1. List balances and APRs. 2. Compute your minimums versus a target payment that would clear high APR in 12-24 months. 3. Check pre-qualified balance transfer offers and personal loan rates online. 4. Set autopay for the higher target payment. 5. Pause new discretionary card use. That checklist moves you from passive to aggressive. Side income lever: if you're tight on cash flow, add a focused 200-500 month side hustle and apply that whole amount to the highest rate card. Even a month or two of extra payments can cut payoff timeline dramatically in 2025's high rate environment. Treat side income as debt accelerant, not extra spending. Quick credit score tip: pay down utilization first on the highest usage card. If one card shows 80% utilization, it's killing your FICO more than a 12% APR on another card. Use transfers or targeted payments to lower utilization and watch your scores react within a billing cycle. Mistakes to avoid: 1. Opening new cards and running up the limit. Balance transfers require discipline. 2. Rolling the transfer fee into the new loan and not paying aggressively. 3. Ignoring small recurring charges that add up. Subscription leaks are real. Fix the small things while tackling the big APRs. Let's detail an actual 90-day emergency plan. Week 1. Freeze discretionary spending and capture an extra $300 via budget cuts. Week 2. Apply for the best balance transfer or personal loan option pre-qualified for your score. Weeks 3 to 12. Funnel all extra cash to the high APR balance. Set autopay to the maximum safe amount. This short sprint often changes the curve. If you can't qualify for transfers or loans due to credit, call your issuer and ask for hardship programs or lower promotional rates. Lenders sometimes offer short-term relief plans to avoid defaults, especially in regions with rising delinquencies. It's not guaranteed, but it's worth the call. Where to get help: nonprofit credit counselors can negotiate lower payments or design a debt management plan. They are not a silver bullet, but can be a helpful alternative to bankruptcy and often get lower interest or consolidation under a single payment. Use reputable agencies only. Now a reality check on mental load. Debt overwhelm often causes paralysis. The antidote is microactions. List, call, automate, attack. Each completed call or payment reduces cognitive load and moves you closer to freedom. Momentum compounds both for debt and for savings. Use it. Policy and macro watch. Regulators and consumer advocates are paying attention because higher total balances and rising delinquency rates increase systemic risk. In 2025, we're seeing more public discussion about interest rate caps and consumer protections. These debates may produce policy changes, but don't wait for policy to save you. Act now using available tools. The Guardian. Case study: Maria, $12,000 total across 3 cards, weighted APR at 24%. She took these steps, got a $7,500 0% transfer, 3% fee, took a small personal loan for the remainder at 11% and set targeted autopay to clear the 0% in 10 months. Within 14 months, she cut interest payments by thousands and rebalanced her budget so credit use didn't creep back. Discipline mattered more than the exact tool. Liquidity safety valve: keep a small emergency fund, $500, $1,000, while you attack debt. Don't blow your cash buffer to pay off cards because one unexpected expense could force a high-cost reborrowing. Use a two-track plan. Sprint payments while keeping a tiny buffer. Tax note: interest on personal credit cards is generally not tax deductible for consumers, so don't rely on tax savings. The motivation to reduce card interest should be purely cash flow and long-term wealth. Redirect money you save into retirement or debt-free investments. How to prioritize if you have multiple balances. Step A: check for promotional or 0% balances first. Step B: if none, prioritize by APR avalanche for best dollars saved. Step C: if you need behavioral wins, knock out the smallest balance first, snowball for momentum. Step D: periodically reevaluate as balances fall. A word on psychology: shame and secrecy make debt worse. Talk to a trusted friend, advisor, or counselor. Public accountability, a partner, a supportive group, increases the likelihood you'll stick to the repayment plan. Social pressure can be a superpower when channeled positively. Mini summary: US credit card debt is rising in 2025 because of higher APRs, inflation-driven purchases, and student loan pressure. The escape path is practical and immediate. Stop paying minimums only, get rate relief, transfers or consolidation, automate higher payments, and use short sprints plus small emergency liquidity to avoid reborrowing. If this video helped, like and share it with one person who's been carrying balances. This info can save them thousands. Drop a comment with your single biggest barrier: lack of cash flow, no transfer offers, fear, and I'll respond with a short first step plan. Debt feels heavy because it compounds like a snowball, but the same math works in reverse. Targeted extra payments, smarter rates, and disciplined automation compound into freedom. Start tonight. Open your statements, list balances and APRs, and pick one extra payment number you'll commit to for the next 90 days. You'll thank yourself later.